All right, what is up, and welcome back to How to Invest in Commercial Real Estate. We have a super exciting show today because we have a guest on the show. We always love guests, find out new stuff. But before that, we just closed on our Amarillo shopping center. Super excited about that. Martindale is the name of that. So that one filled up pretty quick. We should pay out a third quarter distribution on that. We should have almost full quarter there. So
what's cash on cash projection?
Man, I think it's like 12, 13, 14%. It's pretty strong.
Yeah, it's decent. And then we've got another Houston shopping center coming up.
Yeah, we are closing on that in 40 days. So we should have rough legal documents back mid next week. I would imagine we're launching this out to the investor list here in a few days. Yeah, closing on that, I think late August. And it is a grocery anchored center in Houston. Yeah, we love that deal. Super excited.
Good. All right.
Well, without further ado, we are going to get right into our show today. We have a guest, Arn Cenedella from Spark Investment Group, and he is going to give us a little background on multifamily syndication. I know everybody loves multifamily investing or residential housing investment. So without further ado, Arn, give us a little background on yourself and kind of how you got into this and I guess where you are now in the space. We'd love to hear it.
Yeah, great, Aaron. Appreciate you having me on the show. Look forward to having a good chat. Hoping to help your listeners further their investing journey. So appreciate the invite. Look forward to chatting with you guys.
Yeah.
So how'd you get started in commercial real estate? Tell us.
Yeah. Well, that's a whole story. So I'm 69 years old. So I actually got in the real estate business way back in 1978. And it was kind of a fluke. Was in grad school studying chemistry of all things. And at the University of Michigan, go blue. But decided academics weren't going to be my lifelong passion. And so I wanted to do something else. Grew up in the San Francisco Bay Area, basically on the peninsula. What people now know better as Silicon Valley. Called my dad up and said, "Hey, Dad, I think I'm done with school." And he said, well, come on out, get your real estate license, and I'll put you to work. So he had a residential brokerage business in Menlo Park, California, which is basically next to Palo Alto, kind of venture capital of the world, Sand Hill Road, if folks are familiar with that area of the country. So started in residential brokerage business and started buying single family homes as a rental. Did that for about 35 years, did well, was blessed to sell real estate in probably the greatest residential market in the world. And then about 10 years ago, moved to Greenville, South Carolina, was ready just for something different. And about 5 years ago, moved my personal portfolio of single family homes and kind of my residential brokerage business into multifamily. And now I've done probably 7 or 8 either syndications or joint ventures, multifamily here in Greenville, South Carolina, where I live. And I've enjoyed the transition, a lot of opportunity in commercial real estate. And one of the great things I like about it, it's a kind of team sport. So you can partner with people who have skills that maybe you don't have and allow you to kind of accentuate your personal strengths and together form a team that's really, an effective investment tool and help other people invest in real estate. So that's 45 years condensed as quick as I can.
That's good. It'll cause for some questions. So you did residential brokerage and single family home investments for 35 years. You said you transitioned the single family portfolio into multifamily. Talk to us about that. How many single family homes did you have? And then what did that transition look like? What did the transition from residential to commercial look like for you?
Yeah. So At one point, I probably ended up with 35, 40 single family homes, and that could have been in the San Francisco Bay Area as well as Austin, Texas. I kind of have a nose to find kind of ascending markets, got into the Austin market back in 2000, 2001. And of course, I think most of us know what's happened to Texas in general, Austin in particular, though,
Sure.
of course, there are a lot of other great markets in Texas. Um, Interesting because a lot of residential real estate brokers don't really invest in real estate. And it kind of doesn't make any sense to me, right? I mean, you guys know as an investor, your competitive advantage is knowing the market,
Yeah.
right? And whether you're in retail, multifamily, industrial, single family homes, knowing your market, knowing your submarkets is really your competitive advantage. And my father, who was a single family investor, and interestingly enough, never went to multifamily. He went from single family to multi tenant office. That was his kind of transition. And what he told me when I came to work for him was use the brokerage to create income, use the income to create capital, but if you really want to be financially free and wealthy, you can't do that off brokerage. You can't do it transactionally. You need to use that capital invested in real estate long term that creates wealth as well as income. So I just kind of followed in his footsteps. Um, and then when I moved to Greenville, I continued kind of the single family rental, but I made friends with a young guy who had gotten into syndications. And right about the time COVID hit, March 2020, I can remember the phone call to this day. He called me up and goes, "Hey, Arn, what do you think is going to happen with rent collection?" So this was about March of 2020 when I think most people finally understood COVID was actually a real deal and something we had to deal with. And I told Mario, I go, "Hey, I don't know. I got my March rent. Call me April 5th and I'll let you know how the rent collection went in April." And at the end of the call, he turned me on to a podcast about multifamily. And essentially, I kind of started consuming those podcasts, and kind of a light bulb went off in my mind. And that started the transition to multifamily a little over 4 years ago. The other part of it was with the single family, I generally did a lot of self managing, at least for the properties that were in the location I lived in. And I got less enamored of that. So I had to find a partner who loved the multifamily, or sorry, loved managing property. I love kind of hunting deals, networking with people. So that's what I do. I'm the deal finder. I'm the hunter. But I need somebody to kind of operate the day-to-day thing. And when I found him, that's when I kind of moved to multifamily. And from there, I started selling single families, transitioning the cash into multifamily. So that's kind of what I did.
Your multifamily is existing properties, is that right? Or are you developing?
We have not done any ground up development, but what we've been on to recently is buying new construction at CO from builders. So as you know, multifamily volume has dropped quite a bit. And if you think about a property that somebody's owned for 4 years, maybe they got 4.5% debt on it, and it produces a certain NOI. Well, if I'm to buy that property, I got to pay 6.5 now. It's the same NOI, but I got to pay 6.5% debt. So the property's actually worth more to the existing owner than it is to me as a new buyer. And that's why multifamily sales volume has gone way down. And so I started to think, well, who are the motivated sellers in this market? And I would say it's builders, right? Builders build to sell, they take their profit, they go on to the next deal. So our last couple deals have been small build to rent duplex communities where basically we sign a forward purchase contract and buy them at completion. And we've now completed maybe 3 of them, and we're happy with that. We still look at existing product, but there's still kind of that price differential, at least in the multifamily space, that makes it hard to buy existing assets. The other thing is I probably don't have the gonads to do ground up development. I'm an old guy, old school, and I'll leave that to people who know development a little bit better than I do.
Interestingly enough, you mentioned that the existing owners may have a lower interest rate, so the value is different for them than it is for a purchaser. But with new construction, they're going to have a construction loan that's going to be at 7.5%, 8.5%. So that matches up well with today's rates. So you don't have a big drop off in value there.
Correct. And, you know, most builders, developers, they're not really long-term buy and hold investors. It's not what they enjoy doing. It's not what rocks their boat. It's not how they make their wealth. And so I think it's a good fit because I'm very much kind of a long-term buy and hold investor. You know, flipping apartment buildings was kind of all the rage back 2019, 2021. I think that was a historic anomaly period where I think now the investing is going to go back more to kind of this long-term approach, which is what I've always been taught and kind of what I've done. And in my mind, with real estate, if you buy it properly, you operate it properly, you set the debt structure up properly, have ample cash reserves, you just hold that property till it's a good time to sell, and then you take your profit. The only people who ever get hurt in real estate are those who kind of get over leveraged, can't afford the property, and then maybe forced to sell in a down market. So if you don't allow yourself to get in that situation, 5, 7, 10-year period, you're almost bound to win. And that's kind of how I do it.
So talk to us about your syndication setup. Did you have investors or did your partner have the investors? How did you go about finding them? And then after that question's answered, talk to us about the structure of your syndication so our listeners can understand, you know, how other people are syndicating deals.
Sure. Great question. So I have a long career in real estate. I have a good database of people in the San Francisco Bay Area, fairly wealthy area. Most people understand real estate's a good thing to own, and either they don't have the time or the knowledge or the expertise to run it. Seems like a lot of work, and it is a lot of work, and you need to know what you're doing. So a lot of our investors come from the Bay Area, kind of my past residential clients, many of them who also own a handful of rental properties, you know, in the area or whatever. My partner, Brian, is a property manager who maybe manages about 500 single family units in Greenville. And so he has a built-in database of investors who know he does a good job with their rentals. And so then to transition and go, hey, we're doing a syndication buying multifamily is good. I'm very active on social media. We're locked into the Greenville real estate scene. And a lot of our investors are local. They see what's going on here. They want a piece of it. And that's where our investors come from. We're trying to increase our capital raise capability, and we're going to start kind of more formal LinkedIn campaigns and so forth. But most of it has been kind of pre-existing relationships and reaching out to the local community.
Sounds great. Yeah, we're similar. We're always trying to increase our capital raising ability. So talk to us about your structure. What kind of returns are you shooting for? What kind of ownership do the LPs get? That kind of stuff.
Yeah. So our approach to investing isn't probably for everybody. I'll say I'm not a cash flow is king investor. I'm more looking at kind of total return over time. And I'd say I'm also a little conservative. So I'd say I'm more kind of core plus type investor as opposed to a heavy value add. And of course, my approach resonates with a certain subset of investors and doesn't work for other investors. And I think as you develop business and look for investors, you have to understand your approach isn't going to appeal to anybody. Find the people that like the way you're going about doing it and really double down and work with them. So we generally use low leverage fixed rate debt. So we don't have any problem putting 40% down, 45% down. And most of our multifamily deals, we're probably projecting an average cash on cash return 5 to 6% over a 5-year hold. And LPIRRs maybe 13 to 15. And I can say on every deal we've done, we've exceeded projections. So, 6% cash on cash, 14 IRR doesn't sound too sexy, but I ask investors, well, would you rather be promised 10 and 18 and get pause distributions? Then they kind of see maybe slow and steady is the way to go. The analogy I make is our approach is kind of line drive base hits as opposed to swinging for the fences and the home run and the grand slam. Again, not for everybody, but for our investor database, it works. So that's kind of the deals we do: 5 to 6% cash on cash, 13 to 15 IRR. We're ahead of projections on every one. And then typically we'll offer a 7% pref and maybe a 75-25 LPGP split. So fairly standard. The other thing I would say is we tend to do smaller deals. Our sweet spot is kind of maybe $4 to $8 million. So we like that. We actually like the sub 100 unit multifamily because it's easier to get in and get control of that asset and turn it around. The bigger the asset, the longer it kind of takes to turn around the asset. We kind of like to get in, turn around an asset, get that running smoothly, and then move on to the next deal and do the same thing.
No, I like it. Yeah, we have a different model. It's a little bit more aggressive, a little bit higher returns, but there's nothing wrong with delivering returns to investors. And if you're delivering a 14% IRR consistently, then that's great.
How long are you thinking you're going to hold some of these properties?
That's a great question. And I would say it kind of depends on the market.
Sure.
Right now, most of our deals, we have fixed rate debt, either high 3s or low 4%. In general, we probably got another 3 to 5 years on that debt to run. So not a great time to sell, not a great time to refinance. We're just going to ride the boat, keep increasing income and rents, and keep increasing cash flow. And then I think hopefully there'll be a period here, who knows? I don't have my crystal ball, but maybe 18, 24 months from now, rates will be a little bit lower. Cap rates will come back down a little bit accordingly, and there might be an opportunity to either sell or refinance at that time. And our deals are small enough, our average investor maybe writes a check for $50,000 per deal. We have a few bigger investors, but most of them are around $50,000. And typically we maybe have 30, 40, 50 investors in each deal. I think when the opportunity arises to either refinance or sell, we'll try to get a reading from our investor base to see what they'd kind of like to do. And maybe those who want out, we take them out when we refinance. They cash out, they get their profit, they move on. And then others might want to go, hey, let's refi into 5-7 year agency debt and ride the wave another 5 or 7 years. I suspect the majority of our investors will opt to stay in and keep riding the wave. And that's what we'd actually like to do too. Um, so that's kind of the plan, but it all depends on the market.
Yeah, fair enough.
Your philosophy is not too much different than ours. Your current thinking, in that it's not a great time to sell right now. Our multi-tenant retail, not a good time to refinance. So we're kind of holding on to those assets as well.
And the beauty is, if they're cash flowing and performing,
Yeah.
and you're sending distributions to the investors, sit back a little bit and enjoy the wave. I mean, unlike some people in the multifamily space who are pausing distributions and or asking for more capital, that's a nightmare as an LP.
Yeah.
But as an LP in one of your deals, if I'm getting my distribution, everything's going good, I'm a happy camper.
Yeah.
So you said when you look to recapitalize one of these assets or some of these assets, you may look to kind of take a pulse from the LPs and see if some of them may want out. If I was an LP in that deal and said, hey, I ran the first 5 years, I'm happy with this return, how would you negotiate that buyout with the LP if most of them or a lot of them are staying in?
Yeah, that's a great question. So we'd have to somehow fairly accurately determine the value of the asset at the time that happens, right? And that could be lender appraisal, could be broker opinion of value. We haven't really quite figured that portion out, but the way we think about our investors is there are partners, and to some degree, we're honored to have the awesome responsibility of handling their money. And so they deserve, and they're giving us the opportunity to participate in larger commission deals, larger commercial deals. And if we perform for our investors, we're going to be compensated, and that compensation is going to be earned. No problem there. People understand that. But I think if you always keep in the back of your mind what's best for the investor, you create that loyal database of investors who are going to invest in future deals. So maintaining good relations with the investors is really key. You know how hard it is to bring in a new investor. And so if you have an investor who's invested in 2 or 3 deals with you, he or she's likely to invest with you again. So we'll figure out some equitable way to determine that value and distribute accordingly. I mean, if you guys have any thoughts, if you've done it, I'm happy to listen.
I mean, I would say that, when you sell a property, you eliminate all the risk. And so you can give the investors the full value of their shares. But if an investor wants out prior to a sale, they're going to have some discount to that value because as the owner and the other investors, we're retaining the risk of something going wrong in the future or not getting a certain purchase price in the market. And so, we would come to a reasonable solution. But let's say that they invested $100,000 and today's value of the property at full market value might be $200,000 at a buyout. I would assume there would be some discount given, and maybe they get $175,000 or $160,000 today to take their money, and they eliminate their risk while we all retain some amount of risk holding the asset, something like that. But like you say, being a fiduciary for their investors is always important, and treating them with fairness, reasonableness allows them to keep investing with you because they trust that when things happen, you're gonna do the right thing with regards to their equity. So,
Agree.
Yeah, I like that I like that approach. You can give the investor an option. Do you want to buy out at X or do you want to stay in the deal? Because legitimately, as an LP, they're in for the duration of the deal at the direction of the GP, right? So if we decide to refi and want to hold another 5-7 years, we're certainly within our rights to do that. So by then offering them an option, that gives them a decision, and they may say, hey, no, I want to stay in, or hey, I'm happy with the return I got. I'll take my cash and go. So I like that approach.
Yeah, I think the other thing you have to consider is whether or not you're buying it as a sponsor or personally, or whether or not you have to get the rest of the investors on board to buy them out as a company.
Oh, right.
Right. And then you have to go back to them again. Hey, not only do you want to stay in, but now are you okay with buying out half of the equity at this price and injecting more, possibly? Right. That could be an interesting conversation. Anyway, it's always difficult, I think, to recapitalize and also 1031 exchange, right? I think that's a big question. I don't know if you all look at doing that at a sale. Obviously, it can get very complicated. As the general partner, you may even have to do, tenants in common on the next deal. I don't know how you feel about that.
So that's another great question. So I'm an LP in probably 7 or 8 deals, and about 2 days ago, I got an email from a GP and a deal I'm in an LP, and they go, hey, we're selling the property. It's going to close in August. And do you want to stay in as a 1031 investor in the next deal, or do you want to be cashed out? So they kind of presented the option to me. I did invest as an LP in another deal where the sponsor was rolling a 1031 into the new deal. I came in as a cash LP into the new deal, and he rolled in about 80% of his existing clients in the prior deal into the new one. So, as an individual investor, 1031's a great tool to defer Uncle Sam's tax bite out of your equity, allow you to kind of multiply and grow your portfolio. So 1031's a great tool as an individual investor. And so I think it does have some value to syndication investments, but as you indicate, it is a much more complex dynamic to put it all together. There's more moving parts. I do see more sponsors kind of going to that. So it'll be interesting to see what happens over the next couple of years and how preponderant that approach becomes.
Well, man, super interesting to hear about your success and about the history you've had in commercial real estate. If our investors and listeners want to get involved with some of the stuff you're doing, or at least even want to find you on the internet, do you have some website, company name that we can send them to?
Yes, appreciate the question and the opportunity. So it's Spark Investment Group. I'm very active on Facebook or LinkedIn, either under Arn Cenedella or Spark Investment Group. Website is simple, investwithspark.com. And so people can find me, and we pretty much stick to Greenville, South Carolina, where I live. Behind me is a bridge in downtown where there's a river and a waterfall. So we have a narrow geographic focus, but within that geography, we'll buy 70s product to new product. So it's more about the geography and our local knowledge than we buy assets that make sense to us.
Yeah, good. I love that. Yeah. I love that. I think that's a super intelligent move. And I see a lot of people around here, specifically in Tulsa, that only buy in Tulsa, right? Tons of people. But anyway, Arn, thank you so much for coming on the show. I think the listeners will get a ton of value out of today's conversation. And everyone else, we will catch you next week on how to invest in commercial real estate.
Thanks, guys.
Thanks.